Nick, it's good to see you. We're talking about how emotional investing can be costly. Of course, we are fresh off the midterm elections. We knew that would bring some volatility. We are still
Absolutely.
firmly in bear market territory. Stocks and bonds are both negative. The market has lost nearly 16% since the beginning of the year. And just to see what that looks like, I want to show you this chart from FinViz, which shows the S&P's year performance. When I see this much red on the board, how am I not supposed to feel anxious?
I know, right? I mean, it's almost like if we look at from November of last year to November of this year, it's just been this slow drain. Usually if you think about COVID, when that happened, we had this big, 1 month drop, and then the market started coming back.
Yeah.
And this has been this slow, almost like a waterfall bleed that's happened over the past year. And so anytime that you were trying to get back in and you thought, hey, this must be the bottom, it psyched you out, and then it started going down even further. And that's happened over and over and over again, as the institutions really have decided that it's better to be on the sidelines and cash is king. And I think that happened a lot here in this situation. But what you almost need to look at is, number one, remember that investing is the long game. It's not just the next month or 2 months or 3 months. Investing is over a lifetime. It can be 5, 10 years.
Right.
And so what you always want to do is have some money that's principal protected to help get you by during these times of heightened volatility. Use math over emotion. That's another trick that we tell people is when you don't have a plan, it's very, very easy to get emotional when it comes to your money. But what we want people to do is to use their math over the emotion, because this is the cycle. There's all these emotions that we deal with as the market's going up. We have the optimism, the euphoria. Yeah, I can throw a dart at a dartboard and I'm going to make money on any stock that I hit on that dartboard. But then what ends up happening is the market doesn't go up in a straight line. It goes down too. And then we start getting fearful, and then we start panicking, and then we get down to that level of despondency. And usually it's right then and there when the institutions know we're in this despondency, this skepticism, and they're buying in, and then we're out. And so this is why Dalbar did a study that showed that the average investor only earns, I think, 3% on average, because they try and time the market when they're emotional.
Yeah.
And so one thing that you need to do, follow math over emotion. And when I say building a plan, the market doesn't go up in a straight line. And so don't plan for that. When you build a plan, make sure that it's a plan that can withstand both good and sour markets, both ups and downs. You don't want to just, I'm on radio I don't want to put anybody out there, but there is a guy on radio who says you can use an average 12% a year and your financial plan will work. And I'm telling you, the market does not go up 12% every year. You can go statistically back 100 years and know that's not the case. It might average 12%, but you're going to have years where it's up 15 and down 15. That's not saying 12% each and every year. And so just realizing a couple of those things.
That's why we talk to you, because I know that you plan for this when you build these portfolios.
Absolutely.
Also, just to remind everybody watching, you are backed by a team of investment experts at Brookstone Capital Management, and Brookstone CIO Mark Diorio crunched these numbers for us. This shows a $10,000 investment over a 15-year period. If you stay fully invested, hey, you're doing well. But if you just miss the 10 best days, Nick, it's amazing what happens to your money.
It's not timing the market, it's time in the market is
Right.
what this tells us. And usually and Mark does this chart, and it's absolutely awesome. One thing on top of this as well is to realize that your biggest up days are really usually right around your biggest down days.
Right.
And so what happens is we have these big down days and people are like, well, I'm out, I'm done. And what they don't realize is usually the biggest up days are right around those biggest down days. So you don't want to time the market. It's time in the market that really matters. And I think that's why that Dalbar study said the average person only averages a little over 3%, because they keep trying to time the market. When you try to time the market, you got to be right twice. You got to be right when the market's going down. You got to be right again as the market's going back up. So you got to be right twice.
Doesn't happen that often.
No, it's hard to do.
Yeah.
But even though the market's down and it's had a decline this year, there are some opportunities that are out there. There's always going to be opportunities. As they say, when the door shuts, a window opens. And so if you're a 401k investor, sometimes people can get really disheartened and then they say, I'm not going to save anymore. This is just awful. So I'm just not going to save anymore. Now is a good time to save because you can use a strategy called dollar cost averaging. And what that means is when the market goes up, you're buying shares. When the market goes down, you're buying shares. And hopefully you're buying at different prices. And overall, that price is lower. So that actually is a good thing. You could look that up, dollar cost averaging. But another thing, too, is people who have already amassed a lot of money and maybe IRAs and 401ks should be looking at opportunities for things like doing a Roth conversion. Because if you think about it, if you have an IRA, when the market, and it's down this year, when the market comes back, it's going to be rebuilding and the market will come back. But when it comes back, that money is going to be rebuilding, but it's going to be rebuilding wealth that's taxable. Or tax deferred. It's going to be taxed later on. I'd much rather take some of that money since it's declined, convert it to a Roth so that when the market comes back, I'm rebuilding tax-free wealth. Roth money is tax-free. And so I'd rather take it out of this pot here while it's down, move it over, pay the taxes, move it over. And that way, when the market bounces back, I'm rebuilding tax-free wealth, which is awesome. And that's an opportunity that we have now as a result of the market being down.
So you bring up a lot of good points. And, I love that you are a financial expert in your community. I'm sure that when you go to the grocery store, people are tapping you on the shoulder with questions. What is the most common question or concern that you're hearing right now?
So it's really interesting because we have live events all over the city.
Right.
Some of them are at local colleges. Some of them are, at different venues. And so what we'll always do is we'll put these cards on the table. These are little blue cards. And the question at the top of it is, what is your one main financial concern that you would like to hear about? And so we collect these and we have a stack, literal stack of these. And I grabbed a couple from this last event that we just did.
Okay.
And it's funny because the same two questions kept popping up over and over and over again. And so this one came and it said, I've lost a lot in my 401k and my other accounts. How do I know if I'll be okay and if my money will last?
Right.
I think that's one big question people are having. And that was something that we addressed at the live event. And I mentioned that stress testing is so key, where you can take your wealth and you can find out how much more risk is there with where your money's invested. How much further down could it go if this continues to go down? Another thing that I mentioned as well during that event was the importance of getting a retirement income analysis done, which is probably more important now that the market's had a decline than before when the market was just going up. Because now that the market's had a decline, it's very important to know how long your money is going to last. And maybe you did a study and you looked, a year ago and you said, hey, my money's going to last until I'm 95. Yeah, but if the market's gone down 30% or 25%, how long is your money going to last now? I just did an analysis for somebody who it showed that their money was going to last, I think, until like 92 years old. But now with the recent market drop that they've had with their 401k at their employer, now their money's going to potentially run out by age 83 just because of the recent market drop. So that's why it's very important to do that. Another question that I have here is how long is the market downturn going to last?
Right.
And is it going to get worse? And I think, like I mentioned earlier, this has been 12 months in the making of this market downturn. I think we're going to be going more sideways now while the market's trying to find a bottom. But as long as the Fed comes out and says we're not in control of inflation and we're still going to hike up interest rates, so long as they keep saying that, this is going to continue to be a volatile market. And so this could be lasting a little bit longer. What we want to hear is the government saying we've got inflation under control. We're going to be able to slow the raise of interest rates or decrease them or keep them the same. Once that happens, the market will find solace in it and not be so skittish every time the Fed raises interest rates.
I'll feel better too. That makes sense. You're also known for helping people solve complex financial problems. So what should we be keeping in mind then right now?
I think with what's happening, there's bad noise everywhere.
Yeah.
Rule number one, be careful of what you're listening to, because that's enough to make everybody really nervous.
So true.
And so what's happening is people are telling me now, they'll come up at our live events and say, Nick, I'm frozen. I don't know what to do. And it reminds me, every time I hear that, I remember that movie, Frozen, the Disney movie Frozen. And my daughter, who's 10 years old now, she watched that nonstop. I think that was on TV like 50,000 times.
Right. Yeah.
And it was always, what thaws a frozen heart was love, right? And so in financial planning, we kind of have something similar. What thaws a frozen person who won't do anything with their money is a solid plan. And I think what happened is a lot of people with this recent market downturn realized that they had all their money. I would say maybe 80 to 85% of Americans had this portfolio, 60% in stocks, 40% in bonds, and maybe a little bit in cash in their bank. But maybe 95% of their money was in 60% stock and 40% bonds. And then you have a year like now where the market went down. And not only did that 60% on the stock side lose, but the 40% on the bond side lost equally. And now they're looking at it like, oh my gosh, everything got hit this year.
Right.
And it did. And so what I'm telling people now is now is the best time, if there ever was one, to rebuild your plan and to have money that's green money, which is principal protected. It can go up in value, but not down. And then on the other side, you have your risk money. But just rebalance and reallocate your investments so that you have these two piles, red money, green money, with the right percentages. So if the market continues going down, yeah, it might affect the red money. But if you've built the right plan, you'll be able to live through that and have that comeback. And maybe, we can get out of this and this can all be behind us. But ultimately, we don't want to forget. There's too many people, I think, that lived through 2008. The market went down and they didn't do anything. And now they're living through 2022's crash or bear market. And they're saying, wow, I'm doing just as bad as I did back then. And I'll ask them, did you change the plan? Did you change the strategy? And they say, no, I didn't think I needed to because the market kept going up. And the market doesn't go up in a straight line. It ebbs and it flows. It doesn't go up. So now's a good time to come up with a plan so that you can get that comeback, but then be set up better for the future.
Mm-hmm. Well, talking to you, Nick, always makes me feel better. This was really helpful. So was, all that information that you brought to the table. Thank you. So if somebody does want to talk this through with you, again, if they need your help talking them off the ledge, what's the best way to reach you?
Right now, the best way is there's a couple different ways. You can always, there's lots of great resources on our website, group10financial.com. There's lots of great resources there. We have a YouTube channel. You just search for Group 10 Financial on our YouTube channel. We have YouTube videos coming out each and every month. We have a podcast. You can go to onthemoneyshow.com to find out more information about that. Or if you have a smartphone, just search for On the Money with Jerry and Nick Royer podcast. And we have like 100 podcasts. But then there's always going to be that stuff where you can't really understand everything by reading or whatever. You need that personalized, almost like when you went to college and you had the lab session. You can read what's in the book, but then you need the lab to make it real. Right. And so with that, what we tell people is the best way is just to give us a call. We have an entire team of financial advisors who can help you out. And either go to our website to set a virtual visit, or you can schedule a call by calling 844-GROUP-10. And what you can do is set up a 15-minute virtual strategy session where we can see what red flags exist and how to go about fixing those red flags.
Perfect. All right. Nick, thank you very much.
Aaron, great being with you as always.